What's up, everybody? Welcome back to Smart Stock Sam, the channel where we cut through the noise and give you the real picture on what's moving in the market. If you are new here, hit that subscribe button right now because today's video is exactly the kind of deep dive that this channel is built for. We are talking about Beyond Meat, ticker BYND, and why right now, in the spring of 2026, this might genuinely be the most dangerous penny stock trading on any major exchange. A company whose stock surged nearly 58% in a single month, while the actual business was shrinking by almost 20%. A stock that is caught in a collision between retail hype and cold, hard financial reality, and that collision hits at full force on May 6th. Whether you are a long-term believer in the plant-based revolution or a short-term trader chasing volatility, stay locked in, because by the end of this video, you are going to see exactly what is at stake. But before we go any further, let's just take a breath and understand why this stock is behaving so completely differently from what the underlying business would suggest. Because right now, two completely opposite stories are being told about Beyond Meat's value, and only one of them is grounded in reality. On one side, you have a retail-driven surge. In April alone, BYND ripped higher on pure meme-style momentum, fueled by social media chatter and the kind of short-squeeze energy that gets everyone's adrenaline pumping. It's exciting. It's the kind of price action that makes you feel like you're missing out if you're sitting on the sidelines. But flip the coin over and the picture gets a whole lot uglier. We are dealing with a structural decline here. Revenue that is literally evaporating, margins sitting in the basement, and a company that is leaning heavily on its brand story to mask the financial deterioration underneath. On May 1st, the stock closed at 94 cents, dropping over 3% in a single session and failing to hold that all-important $1 psychological level. And that sets up what is going to be an absolutely critical test when the Q1 earnings report drops. Could this stock actually recover, or is the gravity of the fundamentals about to pull it back down to earth? Let's talk about what the fundamentals actually look like right now, because if Beyond Meat were a patient being wheeled into the emergency room, the doctors would be reaching for the crash cart. Revenue is down 19.7% year over year. In the final quarter of 2025, the company brought in just $61 million, a number that came in completely below analyst expectations. But here is the detail that really should make your jaw drop. Their gross profit margin is sitting somewhere between 2.3 and 2.8%. Think about what that means in plain English. For every single dollar of product they sell, they are keeping about 2 cents after paying for production. 2 cents. That is razor thin in a way that should genuinely alarm any serious investor. Layer on top of that a cash burn of $157 million over the past 12 months, plus a fresh round of layoffs hitting 14% of their workforce, the fourth major round of cuts since 2022. And you are looking at a company that is not just struggling, it is actively shrinking itself just to survive another quarter. Could a company burning cash at this rate really turn the corner before it runs out of runway? The math makes it look nearly impossible. And speaking of runway, let's talk about the debt situation, because this is the chart that should keep every single BYND shareholder awake at 3 in the morning. Beyond Meat currently holds about $215 million in cash. That sounds like a cushion until you look at what sits on the other side of the balance sheet: $543 million in total debt. Their debt is more than double their cash reserves, and they are still burning money every single month. When you are in that position, you really only have two paths forward. Either you find a way to flip the business to profitability almost overnight, which given the revenue trajectory seems extraordinarily unlikely, or you go back to the capital markets and raise more money. And raising more money almost always means equity dilution, printing new shares and shrinking the value of every share already held by existing investors. Or worse, a reverse stock split that reshuffles the deck without fixing a single underlying problem. Those exciting growth headlines you keep seeing, they do not change this fundamental math. The debt load is the elephant in the room that completely rewrites the risk profile of this investment. Now here is where the regulatory pressure adds yet another layer of tension to an already chaotic situation. There is one specific number you need to burn into your memory, and that number is $1. Back in April, Beyond Meat managed to regain Nasdaq compliance after going through a messy delay in their financial filings. But they are right back in the danger zone, because with the stock sitting at 94 cents, they are below that critical $1 threshold. Nasdaq rules are clear. If a stock cannot hold above $1, it faces the very real risk of getting delisted and relegated to the over-the-counter markets, which is essentially a financial graveyard for retail investors. The deadline is August 31st. Is there any realistic scenario where this stock holds $1 for that many consecutive trading days, given everything we just covered? That question is what is making the price action so absolutely violent right now. So, what exactly is keeping this stock alive and generating all this buzz? Three big narratives are doing the heavy lifting. First, there is what you could call the military catalyst. Reports have surfaced suggesting the United States Army is exploring meatless field rations. Now let's be crystal clear. There is no formal contract on the table, not even close, but the mere whisper of a government-backed deal has sent retail sentiment absolutely through the roof. Could Beyond Meat actually land a military contract? The odds are slim, but the idea alone is enough to keep speculative money flowing in. Second, the company is making a bold pivot into beverages, partnering with Big Geyser to push a product called Beyond Immerse into 26,000 retail locations. And third, they are expanding their buffalo chicken pieces into 2,000 Kroger stores. These are real moves, no question, but they are narrative catalysts. They promise a future that the current financials have not come close to delivering. They are stories designed to keep investors hopeful while the fundamentals continue their slow deterioration. But if you really want to understand why this stock is moving the way it is moving, you have to look under the hood at the mechanics. 31.76% of Beyond Meat's entire tradable float is currently sold short. We are talking roughly 142 million shares that people have bet will go lower. When you have short interest this extreme, the stock transforms into what traders call a squeeze engine. Any sliver of positive news, a rumor, a headline, even just a slow week with low selling pressure can trigger a violent spike upward as short sellers scramble to buy back their positions. With a days to cover ratio approaching 4, shorts cannot simply exit all at once without sending the price rocketing in the opposite direction. This is exactly why BYND is behaving more like a meme stock than a consumer products company right now. Could a perfectly timed squeeze send this thing to levels that seem completely detached from reality? Technically, yes. Does that mean you should be chasing it? That is a very different question. And the options market is telling an equally dramatic story. On May 1st alone, call option volume exploded by 71% in a single session, with nearly 193,000 contracts traded. The concentration of open interest around the $1 strike price is enormous. Traders are placing massive bets specifically centered on two dates: May 8th, which is the immediate aftermath of the earnings print, and August 21st. This is not random speculation. The market is deliberately positioning for a make-or-break moment at that $1 threshold, and the options flow is screaming that something significant is coming. Now let's look at where the stock technically sits, because from a chart perspective, BYND is in what traders call no man's land. On the downside, the 50-day moving average at 76 cents has recently been reclaimed as support, a positive signal for the bulls. But overhead, the 200-day moving average at $1.56 has acted like an iron ceiling for a long time. The RSI is hanging in the mid-50s, meaning the stock is neither overbought nor oversold. It has room to move in either direction, which sounds like opportunity, but actually just means the uncertainty is maximized right now. Drilling down to the immediate price action, here is your battle map for the next few trading sessions. The stock is currently hovering around 94 cents. Immediately below, there is a floor zone between 91 and 93 cents. If that breaks, things could deteriorate quickly. Above, the primary ceiling is that psychological $1 barrier. If the bulls can clear it and hold it, and that is a significant if, the next target range sits between $1.15 and $1.20, which was the site of a recent rejection and currently represents the upper ceiling for any sustained rally. Meanwhile, the professional analyst community is not buying any of it. The institutional consensus on this stock is a strong sell. The average price target range sits between 66 and 83 cents, implying roughly 30% downside from current levels. Major institutions like Barclays and Mizuho have slashed their targets all the way to 50 cents. Even the most optimistic voice in the room, BMO Capital, only has a target of $1, essentially the floor of what would be needed just to maintain Nasdaq compliance. Is there any scenario where Wall Street's entire analytical apparatus is wrong and the retail crowd is right? It happens, but it is extraordinarily rare, and this fundamental picture makes it even harder to justify. And then there is this. While institutions still hold over 52% of the company, the insiders, the executives who sit in the meetings, who see the internal projections, who know what the next quarter actually looks like, own a mere 1.9%. And in April, the CFO, Lubi Kutua, sold over 400,000 shares at 60 cents per share. Another insider, Terry Whitteman, sold shares at the $1 level. When the people with the most complete information about this company are liquidating their positions during what retail investors are celebrating as a comeback, you have to stop and ask yourself a very uncomfortable question. What exactly do they know that the rest of us do not? All of these forces are now converging on a single date, May 6th. That is ground zero for Beyond Meat's immediate future. The quarterly earnings report will put management's entire pivot narrative under the microscope. But here is the number that really captures just how volatile this moment is expected to be. The implied volatility on BYND options is currently 288.55%. For anyone not steeped in options mechanics, what that number is telling you is that the market has already priced in an enormous and definitive price swing in one direction or the other. The magnitude of the move baked into those options is staggering. When earnings hit on May 6th, the reaction is not going to be subtle. So if you are someone who is actively trading this name, here is what the setup looks like. The zone between 94 cents and 98 cents is where traders are watching for stability before the print. On the bullish path, an earnings beat combined with an aggressive short squeeze could push this toward $1.40 to $1.50, retesting those April highs. On the bearish path, an earnings miss that collapses the narrative could send this crashing back toward 50 to 66 cents, which is where the fundamental analyst targets actually sit. Those are not small moves. That spread represents the entire fate of this company's near-term story. And when you weigh everything together, the picture becomes very clear. Beyond Meat is a high-risk story stock that is currently operating in a state of complete detachment from its fundamental valuation. The retail optimism and short squeeze mechanics are real forces, but so is the shrinking revenue, the crushing debt load, and the insider selling that signals something deeply uncomfortable about what the people running this company actually believe about its near-term prospects. The current price structure, sitting near $1, is simply not supported by the financial reality underneath it. To justify this valuation, the May 6th earnings report cannot just be good. It needs to be flawless in every single dimension. And given the trajectory we have been watching, the probability of that outcome is something every rational investor has to seriously question. Now, before we wrap up Smart Stock, Sam always wants to make sure we are doing this responsibly. So here is your financial disclaimer. Nothing in this video constitutes financial advice. All analysis presented here is purely for educational and informational purposes. Every investment carries risk, and penny stocks and high volatility equities like BYND carry substantially elevated risk. Always do your own due diligence and consult a qualified financial advisor before making any investment decisions. Your capital is your responsibility. All right, Smart Stock Sam fam, we have covered every angle of this story. The meme momentum, the squeeze mechanics, the debt mountain, the insider selling, the Nasdaq compliance clock, and the May 6th collision point. Here is the question I want you to chew on and drop in the comments. Do you think a single earnings report can actually save a company with this much structural damage? Or is this stock in a slow-motion decline that no quarterly beat can reverse? I genuinely want to read your take down below. The comment section on this channel is one of the best conversations in finance on YouTube, and your perspective matters. If this breakdown gave you real value today, please smash that like button. It takes 2 seconds, and it makes a massive difference in helping this content reach more people who need it. And if you are not subscribed yet, what are you doing? Hit subscribe right now so you never miss a video like this one. Finally, if you really want to support what we are building here at Smart Stock Sam and help us keep producing this level of research, you can send a super thanks right here on YouTube. Every single one goes directly into making this channel better. Stay sharp, manage your risk, and I will see you in the next one.